Well, hello and Happy New Year. Welcome to the Finspire's Focus on the Market series for the first quarter of 2022. I'm Chris Karam, Chief Investment Officer with Finspire. We've got a ski theme going on today, so I've got my ski vest and we're ready to go. The title this quarter is Navigating the Slopes of the capital markets, the equity markets, and the fixed income markets all offer us for the year that was 2021 and the look ahead to the year upcoming 2022. And I'm excited to get going. We've got a lot to cover today. First, let's talk a little bit about finishing strong in 2021. It was a strong year in the equity markets. We'll get going, taking a look at that. Two, the labor market. The labor market continues to be in flux. We see lower unemployment rates, but a lesser population participating in the workplace itself. So we'll cover that. We want to talk about the fundamentals. Let's talk about earnings. Earnings have been good, very good in some cases in the fourth quarter. We'll talk about the year that was and also a look ahead to what to expect in 2022. Interest rates rising. This has now been telegraphed by the Federal Reserve. We'll certainly shed some light on what rising rates means for your portfolio. Inflation, if you recall, we did a special edition in the fourth quarter on inflation specifically. We're going to just do a little check-in and progress report as to where we are with inflation today, and then also talk about what to do. What does this all mean for your portfolio? How do you invest in a strategy like this, given everything occurring for 2022? Now, this picture you see here is a little bit grainy, but I will say selfishly, so this is actually the Norga ski jump in Fox River Grove, Illinois. It's about 5 to 7 minutes from my house in Barrington, Illinois. And what's really cool about this place is in the middle of nowhere, or I shouldn't say in the middle of nowhere, but in a rather unusual spot, is actually a very important U.S. Olympic training facility for ski jumpers. So every year, every February, we get to see the ski jumpers showcase their skills every February. But this February, they will all be in China for the Winter Olympics. So just a little fun factoid there that I thought would be interesting. All right, let's take a look at 2021. Boy, did we finish strong last year. What you'll see here is 15 years of history of top performing asset classes to the bottom performing asset classes year to year. 2021 at the far right, you'll see here that the S&P 500 finished strong, almost a 29% total return, which includes price change and dividends. Outpaced small cap investments, which really had a rocky run, especially in the last quarter of the year. Commodities, which really surged for the first 9-10 months of the year, fell off a little bit, especially after the Omicron variant was discovered shortly after Thanksgiving, but still finished with a strong upswing of 15%. And you can see bringing up the rear was both fixed income, which we'll talk about during our interest rate portion of our commentary today, and also emerging markets. Emerging market equities finished the year poorly, negative 2.2%. We'll get into some of the reasons why, but primarily related to the direction of Chinese stocks had a very difficult year, which account for 30 to 40% of the actual emerging market index. All in all, if you had a balanced portfolio, you were smiling. Okay, this was one positive of the year 2021 was that your money, you earned positive dollars on your money, positive return, and double-digit returns most likely in most circumstances, unless you are a very conservative or moderate conservative type of investor. Okay, to give you some perspective at just to how much momentum we carried in from the end of 2020, it carried right through 2021. We didn't experience a lot of volatility whatsoever. You see, we only had 5% pullback in 2021. That's unusual. Typically, we have 4 to 5 in any particular year. This did remind me quite a bit of 2017, where we had no pullbacks of 5%. It ironically happened to be the first year of a new administration. This is not unusual, but it is not something to expect when we look forward. There was little resistance. It was strong across the board. Even defensive areas like utilities had a plus 14% return last year in 2021. Energy, which was on the really hit hard in 2020 as demand sunk for energy and energy prices fell. We have seen the inverse occur in 2021 with energy prices really climbing higher. And that really rippled through into performance of energy stocks. Real estate also, in an inflationary environment, it's not too unusual to see a preference for real assets. Also, with interest rates very low, real estate trusts offer a decent yield on their trusts, and that can also be a nice, could also function as a fixed income alternative for some investors looking for that risk profile or that income stream. The economy is still in expansion. This is critical, right? We could end up finishing the fourth quarter of 2021, although it has not been recorded yet by the government in terms of fourth quarter GDP growth, but we could see a pretty sizable number there, perhaps north of 6%, closer to 7% perhaps in the fourth quarter. And you can see why. Both manufacturing and non-manufacturing activity has been sky high, and really at elevated levels, sustained elevated levels that we haven't seen in over 20 years. And so we are clearly in expansionary territory, which bodes well for 2022 as we talk about economic growth being present, both, again, whether it's manufacturing, rebuilding inventory, or the services sector, which is labeled here as non-manufacturing, both far in expansionary territory and one that we think bodes well for the economy, for economic growth into 2022. Probably not perhaps as great as it was in 2021, but still very positive. And we'll talk about the implications of that in a little bit. So part two, looking for labor. It is no secret if you turn on the news, take a look at what's happening around you in your local communities, that finding labor, finding employees is tough. And the reality is that fewer people are working. Now, there's a variety of factors as to why, but one of the things that I can point to here is something called the labor force participation rate, which over the last 20 years, this is actually a 70-ish plus year chart, you can see after COVID, pre-COVID, and then we fell, the percentage of people looking for work, actively seeking work, fell from approximately 63.5% down to the low 60s, closer to 60%. In fact, I think it dipped just below that at one point in April or the second quarter of 2020. But you can see we only captured about half of that labor force that was removed from the labor force due to COVID. Only about half of that labor force has returned that had left the workforce. So we're sitting here with a labor force participation rate about 61.8%. And that is troublesome because at the end of the day, in order to sustain economic growth, it's a combination of the number of people working multiplied by their output. And so we need more participation in the workforce to continue elevated levels of economic growth. It's also one of the reasons why inflation has crept up and has been more stubborn and stickier than anticipated, because this number, the labor force participation rate, even though we now have an unemployment rate of 3.9%, which is great news, we need more people looking for work. With that, as you might expect, wages are moving higher, right? And this was, as of November 30th of 2021, wage growth reached 5.9%. That sustained itself in the December figures. It was actually a little bit lower than that in December, but still well above historical averages in terms of the impact that it might have, wages moving higher might have on corporate earnings, which we'll look at in a little bit. All right, so let's get into this earnings story. You can see some happiness here on the picture on the right. And the question we get a lot is, wow, how come the S&P 500 in particular, or the equity market in general, and especially here in the U.S., is doing so well? Isn't it overdone? And the reality is that with strong earnings reports like we've had in the third quarter and then again in the fourth quarter was exceptionally strong for earnings, especially when you looked at year-over-year comparisons to the fourth quarter of 2020. Very strong. And you can see here by the index, the S&P 500 index in the line versus the earnings per share in the mountain chart, blue mountain chart behind it, you can see with the rise in earnings per share, we've just seen an improvement in the S&P 500 index. So these two things do go hand in hand. So it is something that we watch very closely, and we're expecting a very strong quarter. Not quite like the fourth quarter in terms of outperformance of expectations, but it should be strong nonetheless as earnings season gets kicked off this week as we speak. Okay, so with that, you might say, well, how did the price to earnings ratio, meaning how expensive the stock market is relative to the earnings that are generated by the companies, the actual ratio, price to earnings ratio, has dipped. It's actually gone downward from close to 24, close to 23, 24 down to 21. And that's actually really good news because when you have declining multiples plus rising earnings, that's actually a very bullish signal. That means that as long as earnings are in line, you could continue to see the bull market trend move favorably. And stocks, although with earnings rising, when earnings rise, that actually means stocks become less expensive based on their price to earnings ratio because the denominator being earnings is doing so well. So we'd love to see this trend continue. If we see stronger earnings, we could see price to earnings ratio or price to earnings multiples actually dive a little bit lower, which would be really healthy and a good sign a bullish sign for the equity market for 2022. Okay, I'm going to throw a curveball at you because when we go through this concept of inflation, which is obviously very important, one of the potential concerns that we have is not just that stocks are generally expensive or higher price, which they usually do when interest rates are real low, but when you do something called the Shiller PE ratio, which is an inflation-adjusted view of earnings, you can see that ratio actually hasn't dipped down. Okay, so this is why the inflation concept is so important. So when earnings are inflation adjusted, even when they're rising, if they're not keeping pace with inflation or inflationary pressures, this is another measurement of price to earnings ratio called the Shiller PE ratio, which basically tells us that valuations are still high when you factor in inflation, despite the fact that earnings are strong. From a pure price to earnings ratio, yes, they're actually moved downward in 2021, but when you adjust for inflation, they actually haven't come down, which tells us stocks may be more expensive from an inflation-adjusted perspective, and that's why inflation can impact the equity market in a significant way, which we'll talk about in a few slides. So let's talk about interest rates, because inflationary pressures usually have pressures higher on interest rates. We didn't see that all throughout 2021. In fact, we saw this great tug of war when interest rates rose in 2021. We saw an immediate jump into the market, into the bond market. Demand for our debt is very high in the United States, and you'd see yields get pushed back down. Well, that was the case. And so if we looked at the spot yield of the 10-year Treasury at the end of the year, it was at 1.52, ironically right where it started the fourth quarter after September 30th at 1.52%. Well, what we've seen since, so in the first few trading days of 2022, what we've seen is the 10-year Treasury jump to approximately 1.8%. It's been oscillating around that number because the inflationary pressures have remained, and you would expect with a strong economic background and higher levels of inflation that you get rising interest rates, which is exactly what we've seen here with the yield curve. We've also know that the Federal Reserve has indicated that they're going to increase short-term rates this year, and I'll talk about that in the next slide. So let's talk about the financial impact of rising rates. What does this mean for your portfolio? Is it all bad? Is it good? Is it bad? Is it all bad? It's mixed. So take a look at, just like we looked at asset class returns relative to one another over the last 15 years for different asset classes, this we dissect just into fixed income. So TIPS, which is Treasury Inflation Protected Securities, Treasury Inflation Protected Bonds, naturally with rising inflationary pressures, there's both a yield component and an inflation component to them, did the best. High yield is right behind it, +6, +5.3. You can see Treasuries, however, were off 2.3%, and the aggregate bond index, which is a very commonly referenced bond benchmark, was down in aggregate about 1.5% in 2021. And that's what's going to happen with rising rates. Rising rates typically mean stronger economy, stronger inflation. Sometimes you get high yield, which performs better in those conditions, and TIPS perform well, of course, in a rising interest rate environment. So diversification was really important in fixed income as well as in other asset classes from a traditional portfolio management perspective. Okay, the Federal Reserve has told us when we talk about interest rates that they are going to raise short-term interest rates this year. This has been a moving target because for a while the Federal Reserve wasn't convinced that inflation was going to be as sticky as it's proven to be. So now that they've come to that realization, they're telling us basically that they're going to increase rates 3 times, maybe 4 times in 2022 because those inflation figures have been so stubborn, which we'll look at in a moment. It looks like they're going to be headed for 4 interest rate hikes in 2022. It could happen as soon as March of this year. So these go hand in hand, as I mentioned, with the inflation story. So inflation is sticky and inflation is rising. So if you look at something that the Federal Reserve uses, which is something called PCE inflation, personal consumption expenditures inflation, up 5.7% when you factor in food and energy costs. When you strip those out, it's 4.7%. Any way you slice it, this is way above the Federal Reserve's target of 2%. When you look at producers experience inflation when they manufacture or produce goods and services. Those ultimately get passed on to consumers, and you can see the producer price inflation is substantial and rising. So as high as 9.6%. When you strip out food and energy costs, energy inputs, it's still high, 7.7%. So eventually this inflation will pass through into consumers. So let's take a look ahead into 2022. Look, from an earnings and valuation standpoint, we still see it doesn't mean that everything is all too expensive. It also doesn't mean everything's inexpensive. There are pockets, value sectors in particular. When you look at PE ratios, for example, in the black diamonds, PE ratios in the small cap arena, the value arenas are quite reasonable. However, when you look at that large cap growth tech space, especially driven by those large technology firms, we see a little bit more expensive, which does not too surprising because they do have great earnings, but they're a little bit more expensive. But there are pockets of opportunity, substantially sized pockets of opportunity. It's not a one-size-fits-all when it comes to earnings and valuations. The other area that we dodged a little bit here in the end of 2021, it appeared that the Build Back Better spending package was not going to go through. It may not go through, which could put a plateau to already high levels of government spending, which could ease some of the inflationary pressures. Nevertheless, we're going to run a very large deficit we ran a very large deficit for the fiscal year end, government fiscal year end, September 30th, 2021. And so you can see that there has been a little bit of a reduction in the percentage of GDP in terms of government spending deficits, which are important. Keeps tax rates where they are, keeps spending levels where they are declining, which could be a good thing to allow the private sector to foster. Should we expect new highs? Yes, we should expect new all-time highs in the S&P. Last year we got 70 new all-time highs. We think those new all-time highs are going to continue. However, it is going to be with greater deviation. So whereas we had 20+% returns the last couple of years in the S&P 500, we might be looking for a much more modest figure, but still very strong in 2022. Again, achieving new highs, much like we did in 2021. However, it's not going to be without more volatility to come in 2022. All right, let's take a look at the year, the summary here. 2021 is in the books. Strong equity market, the labor market. We'd like to see more people to participate in the labor market to contribute to future growth and to control inflation. Earnings have been great. Can they be as strong as they were in the fourth quarter? Maybe not, but they still should be quite good. The Federal Reserve has now changed the game on us a little bit. They've told us what the playbook is for 2022, so expect rising rates, rising short-term rates in the yield curve, and also inflating prices have yet to fully pass through from producers to consumers. So look forward to those consumer inflation figures to rise at least in the first half of 2022, but investment opportunities remain. There are pockets of opportunity in small caps and in value sectors, and growth sectors won't be poor performers, but we do think that there's some relative value to be earned in those value sectors and in the small cap, and actually a little bit in the overseas and emerging market space. Lastly, it's coming up on Olympic season. Go Team USA. You can see one of our skiers here from the last Olympics, and please root them on as they do the best for our country. All right, thank you so much. That's a wrap on the year that was 2021 and a look ahead to the year 2022. Thanks for joining us, and we'll talk to you next time.